like to welcome you to the first panel of the second day of this amazing ICA conference. I'm Paul Chalmers. I'm the CEO of UK Trading Academy. We are the only private educator in UK and Europe that can provide up to fully accredited, internationally recognized master's degree in financial trading. And we're going to be working very closely with the ICA to bring to Dubai a center of excellence for financial trading education. And I'm really looking forward to doing that in the future with Mohammed Hashemi. Now, I get to speak all over the world. I'm very, very lucky. And the one thing that I normally do when I speak is I like to give a fact, a very unusual fact about this amazing world, even though humans are trying to destroy it every single day. And it was very interesting that yesterday we spoke about artificial intelligence and also looking at sustainability. Now, it was nice to see, because I regularly listen to many speakers, and the way AI is represented is very, very wrong by most speakers. I will say that because I quite controversially speak in that way. But it was great to hear Dr. Mark Mobius yesterday, and also Mr. Kapoor, actually talk about artificial intelligence in the right way. There's a lot of scaremongering about artificial intelligence and what it's going to do, and it was great at this event to see Dr. Mobius and also Mr. Kapoor talk correctly about artificial intelligence. What we have today is a great team with me, and we're going to be talking about the future of technology, which is very close to me and to what I often speak about on stage. And I'm going to ask a number of questions to the panel. I have a great team here. They have incredible experience and knowledge in what we're going to be talking about, and it's the future of technology. Now, in the past number of years, we have seen incredible waves of change in the financial services, from artificial intelligence driven to centralized finance and also to digital banks. And the question is, it's not if technology is reshaping finance, but how quickly it's going to happen and what it is. The first question I'm going to be asking the panel is, in your view, what's the biggest driving force in finance innovation today?
Thank you for having me today in this session. Fawaz, Ghazal, CEO of Flooss. We're a digital lender operating in Bahrain, Saudi Arabia, and soon in UAE. So the major advances happening is the government right now there's a lot of fintechs, which we are one. So we're providing financial inclusion is the first phase. And we see now more customized products and services toward consumers, from an enablement to inclusion and using AI and financial data and digital capacity, digital infrastructure that allow us to serve customers faster, instantly, 24/7. And that's the first wave that happened. And we see in the future AI and agentic platform and embedded finance will play a big role.
Avramis.
Okay, is it working or no? All right, sorry about that. Okay, so let me ask ChatGPT for the answer. What was the question again?
The question was, this gentleman is always trouble. I have had this gentleman on a panel many times. I always say that if Father Christmas ever died, this is the gentleman that I would put up as the next Father Christmas. Avramis? What I said was, in your view, what's the biggest force driving financial innovation today?
Okay, so I mean, you know, the funny thing is that everyone is talking about AI like it's something that just landed yesterday, yes? Okay, so AI has been around for decades. I mean, it's funny that I'm involved in a fund that is fully automated, algorithmic trading, blah, blah, blah. And I go after 3 years back when I found out about ChatGPT. Oh, guys, we should do this in the fund, blah, blah, blah. And they go to me, Avrami, go away. We've been doing this for 10 years, yes? So basically, the only thing that changed is the way we communicate with AI. Before, you needed 5 engineers, you needed data scientists and all that to communicate with them. And now we can just chat with them. But what is driving innovation in AI is pressure from consumers, is pressure from people, yes? I mean, especially nowadays, we have the 20-year-olds who can, using their mobile, order a pizza in 15 minutes or a taxi in 3 minutes, right? So there is a lot of pressure to have everything in real time, everything available on the mobile. And this is what is driving financial innovation. This is what is creating digital banking. This is what is creating tokenization and all the other things we are going to talk about later. So this is the single driver, is pressure, because the finance in general is completely inefficient, yes? No one wants to wait for 3 days to transfer their money. We want to have them immediately transferred today. And this is what is driving AI, innovation.
Thank you, Professor Uy.
I'm next. Right. Okay, working? You hear me? Yes. Yeah. Okay. Yeah, to add to this, Avramis, yeah, AI has been around for a long time. I actually understood your questions in a slightly different way. What drives innovation in the financial industry is, in fact, pressure from price pressure, transparency. So my background is FX options, so that's why I'm on an ACI conference, right? So, when I look at the market from a trader's perspective, banks trading, clients trading, and the pressure to quote a good price and to run a good engine, a platform to trade derivatives, that causes pressure, and more of these platforms are coming up. Prices have to be better and faster. So that everybody can still get a share of the market. Now, the pressure is coming in from over-regulation, in my opinion. So I see from our consulting business a lot of smaller institutions capturing market share that banks traditionally covered and using a lot of technology that's out there. And what do? They don't like the regulation in London and what have you. It's too complicated. For example, they go to Malta, small island, right, and to cope with the regulator there to be faster. They want to be fast. They want to be efficient. They don't want to wait 2-3 years to get approval. By that time, the market is gone. So we need to be fast, and that's driving technology, and that makes it faster.
Ben.
Hello. Yep. Good. Okay. So I'm not a financier, I'm an engineer, so I'm going to come at this from a more technical standpoint. And I think the key driver here is competition from big tech. So I think recently Apple opened or created a savings account, and in 4 days, there were close to $1 billion in deposits and something like 10 billion in 4 months. So competition is a key driver here. And I'm seeing that in my space as well, which is data. So we've got new providers, we've got data is the new oil, that's been said, and we've got new providers, good data sets, so much data, and investment funds, hedge funds, need to test this data, right, validate it. And the real bottleneck is human expertise. And even the best hedge funds can really only assess tens of data sets in a year. And I think LLMs and AI will make it much easier to standardize, understand, and automate the ingestion of this data, so you don't have to rely on your 2 or 3 best engineers. You can use these tools, and you can automate this process. And I think in 2-3 years' time, these funds will be able to validate hundreds of data sets instead of tens.
Thank you very much. As I said on my introduction, I always like to give a fact, some very unusual fact about the world. I was reading a paper a couple of weeks ago, and it was talking about artificial intelligence. This can be one for you, Dr. Mobius, when you're speaking next on stage to bring out an unusual fact. Over in America, they have an area in America where the infrastructure, the facilities, the servers are for most of artificial intelligence that goes on in the world, though that is the data centers that do it. And they had to build power stations to be able to do that. And that's why we were looking yesterday at sustainability and also at AI. the fact is, and it's unbelievable when it actually came out at me, you know, when I was reading this document, the amount of power that is required for those data centers to run the AI that we use in the US is exactly the same amount of energy that runs Denmark. How about that? You wouldn't believe it, would you? It actually is the same amount of electricity that they use, power that they use to run the whole of Denmark. That's just a fact for you that you can, you know, that I like to give out every now and again, a different fact each time. But what we want to do now is look at how do we balance innovation against risk. And we have rapid innovation all around the world. But from that comes cyber threats, etc. So my question to the panel is how can we make sure that financial innovation stays ahead of risk?
I think from the question, make sure, it's hard. It's impossible to make sure that you're ahead of risk and innovation. But when you design your products and services, you have to take in fact cybersecurity, sophisticated attacks using AI, bots attacking your platform. But also there's different risks in your business. And for example, from our perspective, innovation is to fail fast and make sure there's a product market fit. It's not just a cybersecurity risk, but we see there's a market risk that you are innovating in a silo. Maybe customers, they don't like what you're doing. They don't believe in that product. There's no traction in that product. So try to do it in weeks rather than months and do proof of concepts much faster. Cybersecurity, regularity risk, all these risks are given fact. You need to ensure that you are doing correctly, you are adhering to all the facts, and make sure that the customer are addressed. Today, Gen Zs and millennials are the new customers that as well moving between generation. They expect in the coming 10 years to have a seamless, frictionless journey, highly secured with regulator approval. They don't want to bother about how it's happening and why it's happening. So all of these risks you have to take care of. And I think getting ahead, make sure you're getting ahead, you do your best bet with the best worldwide practices, but making sure you're always ahead, I think it's a very tricky thing.
Avramis.
Indeed, it's very difficult to be ahead since nowadays we build the rocket and then we say, where's the parachute, you know? Okay, but before I continue on that, your thing on the electricity just reminded me of a meme that I would like to share, which basically says, so our entire economic well-being hinges on a company with 20 billion in revenues, spending 1.4 trillion on AI infrastructure, when there isn't enough electricity generated on the planet to power that many data centers. Yes, and I think we all know which company that is. Okay, but going back to risk, yes, unfortunately, we are going too fast, we are moving too fast, and the risk has to catch up with it. And even though it should be included in the models themselves, it is not. So we have to treat risk as an outside factor. We have to manage it separately, even though the correct thing would be for it to be inside the model. So when building trading models like we do to trade the markets, okay, we build one model to give the signal, another model to do the trades, another model to be the risk manager, and then we have a human, unfortunately for now, okay, that is still there to manage the risk. So you have fail-safes across the board because this is the only way you can manage the risk since you cannot include it in the model itself.
Yeah, so I actually think the human is highly important. First, and I'd like to define or inspire you to define what risk actually is. A lot of people talk about risk, but what is it, right? So from aviation, I know that you have to combine two elements. Number one is the probability of occurring a certain bad event, and the other factor is actually the gravity of the outcome, right? And that's not linked, and both of these are important, right? If I ask you, okay, very simple question about risk. You get into the plane, and today the captain announces you know, today we have a little bit of engine problem, but it's not all that bad. But I can offer you, you can either get the flight today, stay in the plane, and you get it at half the price, right? Or you can leave. Right, maybe that inspires you thinking about risk. So the probability of a crash in any case is really small. It's still going to be really small if it's twice as much, but the gravity of the outcome is the other side of the game. Now, in financial context, what's risk? Let me give an example of what I've seen recently in a real estate, a public real estate fund which crashed. And which was labeled at very low risk when it started off, right? Real estate is something considered stable, you know, the buildings, the office and everything. And so if you buy a whole portfolio of real estate, it's known as small return and little risk, and that's how it was classified. Now something came in 2002, 2003 in Europe, and suddenly the interest rates shot up by 2% within a few months. So the liquidity of getting new loans was dramatically reduced. The prices of new real estate dropped by a lot. And so a lot of these investors suddenly were afraid and tried to get out of this investment. Right, and then they have the fund has 1 year time to get out of this. And that led to a crash because everybody was afraid and there was this herd mentality and everybody's trying to get out. And yet, in the beginning, the risk was classified as minor. Now, why was that so? Because risk was measured from a 5-year time series and it was just looking at the volatility of the time series, right? That's how risk was measured. But that is not the total picture, right? It didn't take into account liquidity or herd mentality of the investors. So risk, bad things can happen typically if a combination of factors come in and then it goes bad. So that's why I'm saying we need the humans to really watch this and apply common sense and not leave everything to a calculator which looks like scientific because some professor has put a tick mark on it. Yeah, we need to really watch everything that's given to us with a sane mind and judge with a human mind also on top of the automation that's behind it.
Thank you, Ben.
So I think technical debt compounds faster than interest. And as we're moving so fast, we've got all of our developers using AI to write code. We're in a place now where the majority of code is going to be written by machines, and the humans directing those machines won't necessarily understand what the code does. So going back to your point on having humans in the loop, I think it's really important that we don't let ourselves get into a space where we don't have experts, you know, and understanding the systems we build. Everything is becoming more complex. We're building on top of code that was written 50, 60 years ago, right? And we're writing more code now than ever before. And we build our systems on open source packages. And there was, in September this year, there was an attack on the NPM package manager, which underwrites or undersets a large number of enterprise applications. There was a worm, it self-replicated, it stole credentials. There were 2.6 billion downloads affected by this. And you can really only get ahead of this if you have, you know, experienced people, but also the automation. So you need to have automated scanning, automated tests. You can use AI to analyze the code written by AI, and these models can be designed in a way to minimize that risk. So as we move forward faster, we have to make sure that we innovate in risk management as well as the actual solutions we're giving to clients.
Thank you. The one thing that when we look at the future of technology, something that hasn't been mentioned, I don't think by any speaker, is quantum computing. Quantum is coming. Quantum has the ability to do so many things, and it becomes quite dangerous. And when you look at the future of technology, we will, in a number of years, be looking how quantum is going to affect the financial industry. And also, from a risk point of view, then it has so much power in the right hands, but let's just remember that it also has a lot of power in the wrong hands. And when we look at vulnerabilities, quantum has the ability to find a pinhole. So it's going to be interesting in the future to see how quantum will be affecting the financial markets. The next item that I'd like to put to the panel is something actually that came up yesterday with one of the speakers, where they said that in this certain country, I can't remember which country it was, that at least 60% don't even have bank accounts. So the next question that I have to the speakers is how we can have financial inclusion to more people in this world. So how can we make sure new financial technologies actually include more people and instead of leaving them behind as we do now?
Okay, we operate in the Gulf, so financial inclusion is not a big issue, but there's underbanked services. But I think the role of the government in general is to lay the foundation for financial inclusion, and that's what we see many governments in the Gulf is doing, like digital IDs, providing APIs from the government that allows innovation, banks, fintechs, and others to provide services cheaply, instantly, frictionless to those customers. So we see that in the Gulf going so wide, and that's the infrastructure where a regulator and a government needs to do, and we see that going into Africa, and this is what happened in India with UPI and other platforms. So all of that is I think the regulator and the government duties to do at the beginning. Otherwise, it will be, each one doing his own thing, and it might work, might not, but then you're going to have a hit and miss in your objectives.
Avramis.
All right, no funny comment this time, because I think that everyone is talking about financial inclusion. We have to include everyone. Everyone should have access to the technology. Everyone should have access to everything, yes? Okay, but let's think about this. When you give to someone who has no clue, yes, what a trading account is, yes, what a loan is, yes. I remember I was in Philippines and I was talking about leverage, that you can use leverage to trade bigger amounts, and someone in the audience said, oh, can I take the money as a loan? Okay, so if you include people without educating them, without teaching them about what is the thing that you are including them in, you are actually not including them, you are exposing them to risks. You are exposing them. So inclusion is a nice thing to say, but without proper education, without people understanding what it is you are including them on, it's exposure. It's not inclusion.
That's part of your mission in life, right? So, okay,
exactly. But I didn't want to, say, as an educator, blah, blah, blah.
No, but it's, I fully support that. Fully support that, absolutely. Yeah, inclusion, yeah, we need to define who is actually the target person to include and what does that person want. Not everybody is the same, right? Give you two examples. One could be an experienced financial markets participant who wants to trade accumulators and FX target forwards, not sitting in front of a PC, but wants to do it on the mobile phone and wants to just click and trade. So the answer for this consumer is click and trade in a modern way, not much fooling around, and get it done quickly, right? So that's this type of user. The other person may be either a young teenager who wants to open first time a bank account, or maybe my mother who wants to do a transaction and is not too much familiar with internet. So it's all kind of different people. So for the retail sector, the simple-minded people, I think what we need is, first of all, simplicity in all the annoying admin stuff, right? So you don't want to run to a branch 5 times to get something done, quick and easy for the admin stuff. But for actual transactions, and when they have a question, they want to have human interaction. They want to have a person like you can ask, yeah, do you want to talk to a silly chatbot when you have a problem, right? First of all, you hang on the phone for 5 hours listening to silly music. Now, that's not what people want, and that's not inclusion. If I really have a problem, I want to have a real human being to be on the other side of it, and that would help including. That's my view.
So I would say here it's about lowering the barrier to entry. If we're talking about the unbanked, you want it to be as low cost as possible and to operate, if you're talking about technology, on as weak a platform as possible. So ideally on the weakest Nokia phone if you can get it, right? So that would be my take, would be to make banking as low cost and as open as possible.
Thank you. I think that the one thing that's come out very clearly here, we can't just say the word inclusion. What we need to do is make sure that we educate the people so that they understand the technology to be able to be included, because a lot of people don't actually know what is out there and what they can actually use. And I think there is a period of time where we're going to have to go through a learning process to be able to do that, which means I'm in the right industry as an educator. Now, if you look at tokenization and the future, the tradability of what we have going forward. Now, tokenization is changing how we think about ownership, and that almost any asset now can be digitized, and it can be traded 24 hours a day. That could be from real estate all the way through to equities. And this also brings new opportunities, of course. And what I'd like to ask the panel is, how close are we to fully tokenized financial system? And what could that mean for traditional institutions and investors?
Okay. From my side, we're about to launch one token. It's a Sharia certified token in a few months, so approved by a regulator here in the Gulf against a Sharia loan asset. So tokenization is happening. It will complement your capital. It will not be the only source of your capital like any other financial tool. So you will use it. So we're giving investors or individuals, this comes on financial inclusion and exposure. Yes, there will be exposure, but previously they didn't have the chance to participate. At least now they have the chance to participate. They have to take on themselves now to learn and get educated by the financial services. But yes, tokenization is here. It will tokenize a lot of assets. It will provide investors and individual investors with new opportunities and institutions to participate in things that used to be like in private equity. Could be big tickets of $5 million or $10 million. Now they can participate with $100, $200, opportunity they didn't have before. That's why tokenization, I believe, is going to grow in the region and globally and will be a part of your capital mix.
Avramis.
Right, so tokenization. What is it really? It's like, it's already been here forever, right? So the skyward miles we have, they are tokens. Yes, this is what they are. In the games you play, the coins, they are tokens. So tokens have been all over the place, and tokenization, how can we describe tokenization? It's basically the innovation of crowdfunding. This is what tokenization is. So we take an asset, we tokenize it, and everyone can buy a little piece of it, which I love it, yes? Okay, I absolutely love it, because, for example, me, I don't like to invest in real estate, yes? I find it too restrictive, and actually I can make more money trading than I can in real estate, yes? But having a tokenized real estate asset, yes, it was launched in Dubai actually very recently, backed by the government and VARA, yes? So it's a proper token, real estate token, completely legal, everything is legal. I wouldn't mind trading that, yes? Okay, because it gives me the flexibility. I can buy a small piece, I can sell it, I can buy it, it becomes tradable 24 hours. So I don't fear the liquidity risk anymore because it's something that I can trade, and everything is going to be tokenized. But it's nothing new, but everything will be tokenized. So basically, it will be faster, execution will be instantaneous, you don't have to wait a long time for the execution, you can buy fractions of it, and everything will be happening in real time on your mobile, and this is where we are heading. So we will tokenize real estate, we will tokenize assets, we will tokenize even the Mona Lisa, yes? Okay, the only problem with tokenizing the real world assets is who is going to keep them for you, okay? But that's another story perhaps for later, okay? So yes, I love tokenization. Tokenization is here. We will tokenize everything, but I don't fear it because it's nothing new, yes? RERAs, real estate funds have been there forever, so we just put them on a faster chain and be able to trade them faster and in real time. It doesn't change. We will tokenize shares. Why? To be able to offer it 24 hours and the game never stops and the party goes on forever, yes? And then that's where we are going to have a problem with humans. We will need computers and AI to trade 24/7, yes? Okay? Because finishing with this, for me, the robots are taking over, yes? Okay? And this tokenization is going to be a part of the whole story.
Yeah, faster, that's the point. When you think of trading euro-dollar spot, right, with a settlement of T+2, right? Everybody knows what that means. So you trade right now and your settlement accounts will settle 2 business days later in your account. People nowadays ask me, so why do we do it like this, right? This feels massively outdated. And so this could be an application, and that's already on the way. We're trying to reduce it to T+1, but with tokenization, it could be real time. It should be, right? Well, you're asking me how long does it take, right? So looking at I could give you a bit of overview of the market in Germany. Tokenization of securities like stocks and certificates is on the way. A lot of banks are working on that. The digital euro is on its way. It probably takes another good year for that to be launched. So the Bundesbank is working on it, massively supported by KfW, so Germany's construction bank. But they want to do it properly. They want to fit it in the overall regulation. So there is a full working engine. They're right now conducting tests, and they want to be fully compliant with the regulations so that there's a huge trust system behind this. So that's why it takes a bit, like in Germany, things take a little bit longer, but it's done properly, right? So that's where we are at that front. But useful, I would say, definitely yes, when you think of contracts that nowadays require a notary, a real estate transaction, right? Because it has to go hand in hand when you deliver the building and when you pay the cash. So it's all conditional. So with these tokens, you can build this and actually save the cost for the notary eventually and get everything done faster. So that way, yeah, faster and useful. But it needs implementation and testing time.
I'd agree on the regulation. I think the technology is there. It's been there for some time. It's all coming down to the regulation. I think the UAE are ahead on this with the digital dirham, and in this part of the world, they're really pushing forward. So I think that's a really good step. I think, though, that there are risks, and one of the things about blockchain is once it's on the blockchain, it's on the blockchain. So we have to be very careful with security when we're doing this. There was an interesting story recently. Robinhood tokenized OpenAI stocks through a SPV. They gave them out to their users, and that was quite interesting. I think OpenAI distanced themselves from that, but that's very interesting to me. As a retail investor, you can't get in ahead of an IPO, right? If they're offering that as a token, I think that's really, really exciting, and that's what yeah.
Okay, we're almost up on time. I can tell that it must have been interesting because I've been watching the number of people getting up and leaving, and it's almost 0. So we appreciate the time that you spent listening to us. I'm sure the panel have given you a lot of great information, but for the last few minutes, what I would like to do is if you have any questions for the panel, we have a few minutes that they'll be able to answer some really good questions from you. So, can we pass the microphone over to gentlemen? Thank you.
Thank you very much. I don't know if this is a really good question, but let me try. So you have all in your various ways described the increasingly transformative impact of technology on the delivery of financial services. And we are moving towards increased customer centricity. We are becoming increasingly efficient. We are even becoming better at modeling risks. Now, contrast this with financial regulation, which still seems to be stuck in this post-Basel III paradigm, where it is all about creating buffers, putting in place guardrails, etc. How far do you think we are from a world where financial regulation can start moving away from these preemptive buffers towards leveraging real-time data transparency and AI and essentially matching smarter financial service provision with smarter, more efficient, more targeted, and even more customer-centric regulation? Thank you.
Which gentleman? There's one thing that I will say, if we look at regulation. In my industry, I work with financial institutions, I work with brokers, I work with trading houses. I live in the UK, I'm from Wales, so I used to take the train straight into London, and I was there at least 3 times a month from Wales. For the last 2 years, I haven't been there. Why? Because the regulators in the UK have closed things down so much that every single one of my competitors, every single brokerage that I use in institutional trading houses are now in Dubai. So I'm not saying that answers your question, but what I'm saying is the regulators are working against themselves now. And if the regulators do not change, then we are going to see things change dramatically outside of the regulatory areas. But would somebody else like to say something?
My view and my experience with the regulator, I think data jurisdiction is playing a big role on what they're trying to do here in the region. So they're enforcing data to be in UAE or Saudi Arabia or wherever you deal. From regulation of financial sector, I think when you are a deposit taker, I think they will force high regulation buffers. But we're seeing they're allowing more risk on the fintechs with a lot of push from the industry. So it's a push and a pull between the industry and the regulator, but they are perceptive. So for example, a year ago, if we're going back to the regulator saying we're issuing a token, it will be a red no. Now they can sit down and say, okay, let's do a POC, let's sell it to the market, doesn't have to be accredited investor. They're listening. And that's the beauty of our region. And I just tell a story, like a year ago, I was in Canada, I want to open a bank account for my daughter. I couldn't do it online. Still, it's like 10 years back. You have to go get your passport, ID, somebody has to view you, although they have the digital infrastructure. But the regulators, maybe in developed market, because of the market size too big, they are not willing to take any risk. Our market size compared to them is much smaller, and I think regulators are willing to listen and do a lot of changes and give some room, but not in customer deposits. I think that's fair.
Thank you. Any other questions?
Yes. Yes, hello. This is Ahmed El-Gamal from Bank of Misr. I would like to elaborate more on the impact and risk balance part of this fruitful discussion. And my question is, how do we unlock the benefits of advanced fintech and AI, but without creating new systemic risks in the financial sector? Thank you.
Somebody like to answer that?
Okay, so let me try and answer that difficult question. Okay, so actually it's easy. You can't. You can't. Okay, you cannot do it. You simply can't do it. I mean, the regulation is not there. Regulation is miles behind, especially in the developed countries, and everything is on the blockchain. Everything is on the internet, and it's becoming self-governed. Yes. So answering also the question about the regulation is miles behind. It will never catch up, and it will always be behind because the people, especially the younger generation, these, what are they called, the Gen Zs and the snowflake generation, okay, they are online, they are doing everything, and they are bypassing all regulations. I mean, once they tokenize everything and everything is on the blockchain, who can regulate, who can regulate the blockchain world? How can you do it?
I'd add one thing to that is that we can build resilient systems. So you can accept that there is risk and there will be damage, but you build your systems so that the blast radius is as small as possible. So you isolate your important pieces. That's what I'd say.
Yeah, well, it's there are things you can do. So you can do education. Okay, that's missionary work that a lot of us do. So that's good and should continue. One can also use the technology, existing technology, to help and guide our regulators and include them, right? So for example, a counterparty credit risk model for a derivatives trading firm can be generated. Like we, for example, we generate a validation model validation report now within a few days. It took a couple of years before, using technology, using AI and using clever programming. And this has a lot of educational elements in it, like illustrating risk, illustrating scenarios, put it up in a graphical way to make people understand faster what's going on and not just read like 500 pages of text when nobody knows what's going on. So there are possibilities to get there. It's not hopeless.
Yeah, thank you.
I was just being more.
Sorry.
I was just being more honest.
Thank you. That was an excellent question. My simple answer would be this: that a lot of people are worried about how we're going to advance technology. You know, what is the new technology out there? What is coming? We don't have to worry about that. The technology is being developed. In 10 years' time, it is going to be typically a very different world than it is now. The work needs to be done on mitigation of risk in so many different ways. Any other questions? Yes.
Yeah. In the previous panels, we were discussing how deep the bond markets and you know, in local markets like Jordan, UAE, and not UAE, let's say, there is no secondary market or repo market. So if banks went into, or let's say government went to tokenizing this, can this create, as you said, more liquidity and more deeper market, more repo into the bonds and those stuff that we miss in the region?
Fawaz, I think, yeah, you would be
Depends
best
from where you're getting that liquidity. If you're just selling it in the local market, there's no more liquidity. If you're selling it globally, yes, there's liquidity coming in. But then that depends
it's
on...
in a local currency, so you cannot...
It's a local currency, no. You're just taking liquidity out from the local market. There's no additional liquidity coming in. It's just a tool like any other tool.
But what if we could tokenize it? And then someone from the US buys a piece, someone from India buys a piece. So you can tokenize it, put it out there in the world, and go for it.
Okay, we're up on time. Thank you, everybody, for spending the time with us, listening to our esteemed speakers. I'd like to thank them very much for the enthusiasm that they've given and the excellent feedback to everybody. Thank you.
Thank you.
Thank you, Mr. Paul Chalmers. Thank you to our distinguished panelists. The QR code has been put up for everyone to scan.